Hello viewers, welcome back to our YouTube channel cpacertification accounting tutorials, and today we want to continue with our series on bank reconciliation. We looked at our number one, that was basically looking at the factors that are causing the difference between the bank statement and the cash book balances. And what we want to look at today is we want to look at the structures or the formats or the layout of the adjusted cash book that is going to help us solve all the mismatches that we had in our cash book. We'll be able to adjust errors and also look at the format or the layout of the bank reconciliation statement. Then we shall also decide which preferred way are we going to be able to prepare this bank reconciliation statement. So that's what we are going to look at in this video. So allow me to take off my video so that we can be able to have a full screen view of what we are going to discuss today. All right, this is bank reconciliation part 2. Bank reconciliation. This is part 2. And the key things that I want us to look at, as I said, we will need to look at the different formats of the bank reconciliation. We'll look at the format of the adjusted cash book, and we'll also look at some other factors that we think that may be important and we haven't spoke about them. Then also deciding on which format are we going to be taking for solving bank reconciliation questions. So let's now kick off with, let's start with the adjusted cash book. So adjusted cash book. So first of all, we have to look at the format of this adjusted cash book, and then we shall also look at the one for bank reconciliation statement. And then maybe if time allows, we'll take a practical question to see how we can do that will help us to prepare the adjusted cash book or the updated. If they don't call it the adjusted cash book, you can call it the updated cash book. You're just updating the previous one, because in the question they will give you both the bank statement and then the cash book of the business. Then you'll be able to maneuver through, see what is required and see what to do. So this adjusted cash book is going to help us to adjust those factors that caused the difference between the two balances, which were from the side of the cash book. So the adjusted cash book is mainly looking at those factors that caused a mismatch in the balances, in the two balances of the cash book and the bank statement. But when you're looking at the adjusted cash book, the main factors that we are looking at, those are the ones that are arising from the cash book itself. And those are the ones that caused the bank statement to be, or that caused the bank to be adjusted in the balance in the bank reconciliation statement. But before we look at that, let's just first look at the format of the adjusted cash book. So the format of the adjusted cash book. Format of the adjusted cash book. So you'll always begin with the balance. You always begin with the balance as per the cash book, the balance that was given to you in the question, the cash book balance. So the question will always tell you that the cash book has shown the balance maybe of $10,000, $20,000, whichever balance they have told you. And then they will also tell you the bank statement also shows the balance of, let's say, 7,000 US dollars. Or they may not tell you that, they may just give you the figures, because when they will give you those balances, we saw the column for the balances, you can be able to pick the balance from that. Therefore, when you are starting your adjusted cash book, you always begin with the balance of the cash book. So if it is a debit balance, then you put it on the debit side of the cash book, of the adjusted cash book. And if it is a credit balance, then you also put it on the credit side of the adjusted cash book. So in the format that we are going to prepare, I want us to assume that a balance was on the debit side of the cash book. So we are going to put it in the debit side. So how it looks, the cash book, it's the same way we looked at how the cash book was looking like. Just a T account. Remember, we are only picking out the bank column. This is our adjusted. So we shall have the dollar sign here, or the currency, whichever currency, can be in shillings, can be in shillings, whichever currency that you are doing that in. So we will say that we are going to assume that the balance is in. So I'm going to assume it is balance brought down. We are going to put it there. Just going to be using X to mean those values. Just represent them by X's. So that's our balance brought down. And the next thing to do is to go through the factors or the reasons that caused a difference, and you find out which ones were from the cash book. So what we are trying to do is that we are trying to adjust the cash book to get the correct balance for the cash book. Therefore, the things that were supposed to be debited to the cash book that were not debited, then you'll come and debit them here. And also the factors that were supposed to be credited to the cash book and they were not credited to the cash book, then you can come and credit them here. So if there was an error in the cash book originally, then you can also correct that same error, because we said errors that are committed in the cash book will always be adjusted from the adjusted cash book. So if there are errors that are committed originally in the cash book, then you correct them here. So for now, there are some common items that usually appear in some of the questions, and I want to show you how we can treat them. For example, if you look at on the debit side, because this is the debit side of the cash book, this is the credit side. So if you look at the debit side, most common things that you will see, we have things like credit transfers or direct deposits, credit transfers. Say the other name is direct deposits or direct debits. And I explained credit transfers as when someone makes a direct deposit into your bank account without your knowledge. And when that happens, the bank will credit your account, and when the bank credits your account, then the corresponding entry is that you must debit your cash book. And if previously you didn't do that, then you can now do it by correcting that issue. That's why we are bringing here that figure. We said you can call it direct deposit or credit transfer. We are looking on the debit side alone. The other, we have things to do with interest that was credited to your account, interest income received, interest credited to your account by the bank. In other words, any income credited to your account by the bank when you are not aware. So whatever the bank has done that you didn't do, then it's what we are trying that's what we are trying to bring out so that it appears in the adjusted cash book. And that's what usually what we do. So we bring in the interest received. We can also bring in things like the dividend received. Dividend received. The dividend received. So the dividend received, the interest received, those are the ones that we are. So what we did, we look at what we did, but the bank did not do. So when you are in the adjusted cash book, you look at the things the bank did, and for you as a business, you didn't do. But when you go to the bank reconciliation, the things you did as a business, but the bank never had those transactions, they are the ones we do adjust in the bank reconciliation statement. So I want us to get the difference from the start, that the things the bank did that we had no idea about, they are the ones that we are bringing in our adjusted cash book. And the things that we did as a business and the bank never had any idea of what we did is the one that we take to the bank reconciliation statement. Therefore, the things I did as a business in my cash book that did not reflect in the bank statement will be adjusted or corrected in the bank reconciliation statement. And the things or the transactions that the bank has recorded, which we, the business, was not aware of and we didn't do, then we are now showing them in our cash book. So usually you see that the things that are here in the adjusted cash book are the things that are in the bank, which are not done yet by the business. So those things that the bank did, for example, if let's say if the bank credits our account with an interest, then we have to adjust our cash book by debiting that same interest. I hope we can now pick this side. So let's now go to the credit side. Let's go to this side of the transaction. So the credit side of the adjusted cash book, we also look at the common things that are always there. So when I talked about the standing order payment and I expanded a standing order in my previous video, because we looked at the kind of things that the bank can pay on behalf of the business through that standing order, whereby the bank instructs the business instructs the bank to make some payments on its behalf. So what happens, the standing order, what happens is that the bank has paid an expense on behalf of the company, meaning that our bank account has been debited. And because of that, we will come and credit our cash book. So we bring things to do with standing order payment. Standing order payment, such an amount. Standing order payment. And we also talked about bank charges, and these are things that are already done in the bank, and the bank has already charged our account, which means that they have already debited your account, and because of that, you will have to credit your cash book. And because you didn't do that initially, that's why we are doing it now. So we also bring in the bank charge. Bank charge, management fees, and others. But we need to take note that there can also be interest charge. Among these expenses, there can be an interest charge as well. And the interest can be on the credit to your account as an income received, as we saw it from here. But it can also be a charge to your account. If at all, maybe you had taken a bank overdraft, you had borrowed some money. Maybe you had taken a bank overdraft, but it's now an example of it's like an example of a bank charge, whereby it will be deducted separately. So I want you to appreciate the fact that interest expense can also be charged as well as received. So once you have interest charges, then we include it there, interest charges. It can also be received. When you are receiving interest, maybe you have made some fixed deposit, or it's a savings account and they are paying you something. Now, also if you see a dishonored check in the question, for example, if you have received a check from your customer in settlement of their debt, let's say you had sold to them on credit, the customers, meaning you have your debtors. So you find that you had already debited the check as a receipt in your cash book, because previously when you receive a check and you take it to the bank and the bank dishonor it, or they refuse to pay, there are reasons that we may not look at for now. There are reasons for dishonoring a check. It could be maybe the person who signed never signed well, the signatures they are not matching. 2, the amount could be insufficient. The person may be paying you 2 million, but on the account there is only 1 million. It can be dishonored for that reason. Even when you have not put in the right, you have left some spaces, the signatures, like you wrote differently, you signed in a different, where you're supposed to put a name is where you put the signature, and where you're supposed to put a signature you put the name. So those are some of the small things that can lead for a check to be dishonored. But what I want you to understand, the main point is that a dishonored check happens in the cash book for you when you received it from the customer. You debited your account because you thought the customer is paying you. you saw money is coming in the business, so you debited your cash book. So once you debited your cash book, but you took the check to the bank and the bank refused to pay, they dishonored that check. So it means since you had already debited it, you must credit it to remove it from the transaction. Because if you leave it there, it's going to increase the balance. It is assumed to have increased your cash book balances, yet you didn't actually get that money in your bank statement. So what you do, you credit it to remove it. So dishonored check. So the reason why the check has been dishonored, meaning when the check has been dishonored, it means the bank has not credited your account. And once the bank has not credited your account, but you had already debited your cash book initially, then what you do, you have to write it off to remove it. So what happens is that because you had debited initially, you had debited your cash book initially, then, and the bank did not, the bank did nothing, it didn't pay, didn't credit your account, then now what you do, and once you have known that the check has been reversed, then you can come and also reverse the entry for that dishonored check. So that's basically what we are doing. If it happens in the other way around, whereby you paid the supplier but the check was also dishonored, you also do the same. Because me as a business, I can also write a check to the supplier when the money is not there, and it will be dishonored. So you do the same. You now it will be going this side, the debit side, because previously I had credited my cash book. Now we also have things like the direct transfer. No, these are not direct transfer. They are debit transfers, or what we call the direct debits. These direct debits, those are scenarios where the bank charges you money without knowing. So the debit transfer doesn't usually appear in the cash book. It is also similar to a standing order payment. So there could be something to do with those direct debits. But what you have to know is that the bank can't just deduct money like unknowingly without your knowledge. Of course, it may appear that it may be the opposite of credit transfer, whereby this time around the bank will be the one to deduct. For the credit transfer, it is the customer paying, but for this, it will be the bank deducting. It is very possible, like for these businesses that run Google ads, Facebook ads, as long as you have those ads, you find that on your credit card, money was deducted using your either credit card or debit card. Because when you are paying for these Google ads, through those social media advertisement, through those ads, what they do, money is deducted directly. It's as if they just deduct it from your cash, as long as you attach your credit card or ATM card on, because there is no way you're going to use Google ads minus attaching your ATM card numbers to those Google websites or Facebook ads. So that money can be deducted directly. When the ad ends, money will be deducted direct. They may not inform you, money will just be chopped from that account. If let's say you are buying you are buying these things to do with the subscriptions, it may be there automatic that the money will be deducted. There are these subscriptions, annual renewal. You find that when the time reaches, money is picked from your account, especially for Google ads, Facebook ads, social media advertisement. That's how they deduct the money. You put here your ATM card, you connect it to the website, the money will be chopped as long as it means a certain threshold or the advertisement is complete. So there could be those direct debits whereby they can pick the money. It's a little bit different from standing order, because standing order, it's the business authorizing. It comes in play only that by the time the other person you are paying submits the invoice for payment in the bank, you may not be aware. But for this one, it is automatic. The money will be deducted and submitted to Google or Facebook. Now, the last point that I want us to look at, errors. They're about errors. And I told you errors can be made in the cash book, and I also say that it can also be made in the bank statement. But I also told you that in the previous video we talked about that when errors are committed in the cash book, then they are supposed to be adjusted in the cash book. If errors are committed at the bank, then the correction of those errors must be made in the bank reconciliation statement. And what we are going to do is that we are going to indicate the errors on both sides, because errors can be made on the debit side or on the credit side of the cash book. So we are just going to put errors made. Even here I also put errors made. I'm indicating it both sides because I said errors can be made in any way. Now, we can now look at those as our basic. So, we shall take a practical question to look at how we can be able to sort that. But I want to comment on something, how we close off this account, because it's also very important. Allow me to remove some of these so that I can be able to write how we close the account. Let me also use a different color so that we can pick it, because it's very important. Let me use even red. Now, having understood or having adjusted all the items that we needed to adjust, we need to have balance of this account, like what we always do for every other account, these ledger accounts that we do. So what we do, we always look at which side is bigger. And these balances can be on any side. It can be on credit or on the debit. We get now the difference. If this side is bigger, we can just put the figure here as our total. We make the bigger one to be the larger value. Now, if the difference is on the credit side, then that would be a balance carried down. So we can have this as a balance carried down. Let's say of this, that would be a balance brought down this side. So it would be a balance brought down this side. Balance brought down this side. Now, this balance brought down here is the one that we call balance as per the adjusted cash book. balance as per adjusted cash book. Is the balance as per the adjusted cash book. So that's the balance that we shall take to our bank reconciliation statement. So that same balance, we are going to use it to start our bank reconciliation statement. And that's basically the format of the adjusted cash book. Now, let us look at the format of the bank reconciliation statement as well. But a bank reconciliation statement can be prepared from many angles, either by starting with the balance as per the adjusted cash book, or we can begin with the balance as per the bank statement. Can begin from anywhere. Because we also said that when there are wrong debits and wrong credits in the question, then we can adjust them also in the bank statement or bank reconciliation statement. And if there are errors that are committed by the bank, then we can also do them in the bank reconciliation statement. So I'm going to give you a very simple format or a very basic format of bank reconciliation statement first, and then afterwards I will explain and also add on how to correct errors and wrong debits and wrong credits that we may have. But for now, I'm going to give you a very simple and very basic format for bank reconciliation statement as per the things that we have discussed, but we shall keep on adjusting it for the different aspects that we shall look at. So the format of the bank reconciliation statement. Bank reconciliation statement. Now, we always begin by the heading. We put the date, and then you also show of course, you begin by the name of the company, you put the statement you are preparing, then you also put the date as at, you give the date of the statement, and also you bring in the currency symbol. However, I'm starting with the balance as per adjusted cash book. So balance as per adjusted cash book, as per adjusted cash book. Let me just call it CB. That is the balance I'm starting with. And we also write it as balance as per the adjusted cash book. And after that, what we do is that we are going to add unpresented checks. Add unpresented checks. Unpresented checks. There could be a number of checks. So we add the unpresented checks. We could be having maybe check number 001, 002, whichever. Then when you add them, of course these are going to be in columns. Bring the figure here. If you add these two, bring the figure that side. So after adding those two, after adding the unpresented check to the other balance as per adjusted cash book, what we are going to do is we are going to less off uncredited checks. We can also have more than one. Can have 0, maybe 00, 0010, 005, 011, their figures are there, their figures are there. When you add the two, you less them off here. And when you less them, you'll be able to get the balance as per the adjusted cash book. This will be balance as per bank statement. That will be the balance. That's the basic format. So once you have added the unpresented checks, but as I said, there could be more than one checks. So sometimes they may give you check numbers, sometimes they may just give you figures. So once you add them up, if they have given you very many or names of customers, you list the names of the customers and sum up their values before you add them to the balance as per the adjusted cash book. So once you add it up, you can also be able to take the figure this side, and it will be this figure that we shall less off from the unpresented checks, the uncredited checks. And after adjusting for this, after adjusting for unpresented checks and the balance as per adjusted cash book, then we can take out these uncredited checks, and these are also you can find when they are very many, so you adjust them. If they are given you name of the people, they have the names of people or the check numbers, you write the check numbers, you sum up their totals, and you get that figure that will be deducted from this to be able to give you the balance as per. So after doing all that, you will be getting the balance as per your bank statement. So you arrive at the same, that balance as per the bank statement, you'll arrive at the same amount or at the same balance as per your bank statement balance. It will be the same. So it will always give you that same amount that they have given you in the question. Most of the times, if the bank statement doesn't balance, you just know you have made some errors somewhere. So someone may be wondering, why are we adding the unpresented checks and why are we lessing off the uncredited checks? Now, we are adding the unpresented checks because the unpresented checks are checks which have been issued to they have been issued out by the business to our suppliers or creditors, and we expected them to go and present it to the bank for payment. And in our cash book, we already subtracted that amount from our balance. In other words, we have already subtracted that from our balances. And these people, they delayed or they didn't present these checks to the bank for payment. And for us, we thought that our balance had already gone down, and only to realize that suppliers did not present their checks for payments, and the balance at the bank still stands as it was. So because we took out of our cash book, we took these unpresented checks out of our cash book balance, and we have now known that they didn't actually take out money from our bank account. Then we need to add it back, at least so that we can use it to get the same balance as per the bank statement. Therefore, these suppliers, they did not present it for they never presented those unpresented checks for payment. So the balance, all the money that they didn't withdraw, is still standing in our bank accounts, and thus we are adding it to show that the money is still available, because in our cash book we have already subtracted that as if we have already cleared them. That's why we are starting, we are basically starting with the balance as per the adjusted cash book, because this is the correct balance as per our banker statement. But because there are those transactions that happened in the cash book, but they never got affected in the bank statement, we need also to adjust them under what we call the bank reconciliation. Now, at the same time, we are taking off these uncredited checks simply because these uncredited checks are checks which were received from our customers, but when we took them to the bank, we expected the bank to credit our accounts. But because maybe for some reasons they have not yet created our accounts, but from our side in the cash book we have already debited. It's like we have included that figure already in our cash book balance. So what we can do is to take it out. Let me hope you are understanding this argument, because this balance as per the adjusted cash book, this is the corrected or the updated balance, meaning this amount for unpresented checks, for us we thought it was already deducted. That's why when we are constructing this balance adjusted cash book, we started with the balance as per the cash book. We adjusted it with the things that were not reflecting in the cash book, meaning these uncredited checks, they are still within this balance as per the adjusted cash book. That's what that's the meaning. And the reason why we are taking them out is because we want to see that balance reflecting the balance that is in our bank account. So since we had already debited our cash book to show that we have received money, or our cash book balance is increasing, but we realize that the bank did not credit our bank account. So what we will do is to subtract it from the balance as per the cash book, so that we will understand that the bank balance wasn't increased or wasn't credited as we thought it would have been. Therefore, once you are able to do that, the adjustment then will be leading you to arrive at the balance as per the bank account. And that's basically how a simple bank reconciliation statement is prepared. But before we conclude, we also have to know that the bank reconciliation statement can also be prepared in an opposite way, whereby you begin with the balance as per the bank statement. And when you begin with the balance as per the bank statement, then it means that you are adding up the uncredited checks, and then you are taking out the unpresented checks. So it can be in the other way around. Let me show you how it can be. Bank reconciliation can just put maybe bank reconciliation as at, remember I told you to always put the date. Bank reconciliation statement as at, you put a given date they have given you in the question. Since we are using a format, allow me just ignore the date, but you always put the date. Now we are starting with the balance as per the bank statement. and we show that figure on the right hand side. So it is, we always do it in columns. Put 3 where you add just values. Of course, you have to show the currency. So you start with the balance. You start with the balance as per bank statement. I'm just going to call it BS, bank statement. We put it this side on the right hand. So now we add back uncredited checks. You list them if there are many, 001, 003, 00 whatever. You put the figures here. After adding, you get of course that value, then you less unpresented. May I prefer the other first one, but just know even this one is there. 008, can call it 008, 001, 002, this one, and we get this very final value there. And that's what they call the balance. Now this one will be balance as per adjusted, balance as per the adjusted cash book. So you can prepare it in this way or in the other way, depending on which way you want to use. So we started with the balance as per the adjusted cash book, which is that one. Then we add adjusted, because now when you start with the balance as per bank statement, then you must arrive at balance as per adjusted cash book, meaning still you need to prepare the adjusted cash book. So you start with the balance as per the bank statement. You take the bank statement balance, and then you should arrive at the adjusted cash book balance. And when you start with the adjusted cash book balance, then you should arrive at the balance as the bank statement balance, or the balance as per the bank statement. So whichever way that you may want to go by, you will be correct. And that's basically a simple way of presenting a bank reconciliation statement. And I think it's important for you to understand these basic dynamics, because we look at, if you are, it's better you understand this, the basic way to do a bank reconciliation before we look at other aspects. Because other aspects, I told you, we have things to do, like things to do with wrong entries and correction of errors, and other aspects that may come across. Because I told you there are going to be very many factors, others will see them, the things to do with over and underestimations, they may appear. So we are going to try and look at the case where the adjusted cash book balances resulted into a bank overdraft. Because the other side, we looked at a situation where our adjusted cash book balance had a positive balance. The balance as per the adjusted cash book, what we prepared first, was a positive. But we want to look at a scenario where our balance as per the adjusted cash book is a negative, or it comes as an overdraft. In other words, the balance appears when you are preparing the adjusted cash book. We find that the balance brought down is going to be appearing on the credit side of the adjusted cash book, which indicates that there was an overdraft. So once you get an overdraft, how do we now be able to get these formats, because the format may change a little bit, especially when you are looking at in the scenario where we've gotten a bank overdraft. Now, I want us to assume that we are taking our first format, the first format that we looked at, where we start with the balance as per adjusted cash book, add back unpresented checks, then you less off the uncredited checks. That's our format, first format. And then we get the first format of doing the bank reconciliation statement. So we want to look at a situation where we have an overdraft. How do we go by that? So we can just duplicate this, maybe. We can duplicate this. If this is an overdraft here, just something small I need to clarify here. So we said it is going to be an overdraft. So we either say that we have an overdraft here. Instead of saying balance as per adjusted cash book, we say overdraft as per adjusted cash book. Or we can say balance as per adjusted cash book, and then in the bracket here we put OD, the word OD, just OD, to mean an overdraft. You can also decide to ignore that OD, and then you just show the overdraft as per adjusted cash book. So whichever way you take, whichever way you go by will be okay for the examiner. However, once you get an overdraft, then the format will change, because what we know from here is that we add our unpresented checks. But because it is an overdraft, we are not going to add unpresented checks, but rather we are going to add the uncredited checks. This side will change a little bit. Here we shall just add maybe the uncredited checks. So these will be uncredited checks. Then this side we shall only less the unpresented. So if you have this as an overdraft, you can just call it overdraft as per. So that's what you can do if at all. Now, what will happen to this downside? The balance here. The balance, of course, after adding the uncredited checks, then you less off unpresented checks, you'll be able to get that balance, whatever balance that you will get. It may be an overdraft, or it may actually be, it can be a negative or a positive figure. So once you add this, even this side may actually be an OD, overdraft. It can be a negative or a positive. So once we less off the unpresented checks, then when we do that, we shall have the balance as per the adjusted, balance as per the cash book balance. Balance as per the bank statement. And still this can be an overdraft, or it can be a negative, which is an overdraft, or it can be a positive, which is just a balance. So it can be, the final answer can be a negative, or it can be a positive balance. So that's the small change that I wanted to show you. But I want you to take note that you can start a question with an overdraft and end with a positive balance. Or you can start a question with a positive figure and then you end with a negative balance. All depends on how well you have understood these concepts. Now, having understood how to deal with the simple formats of these bank reconciliation statements. Then I want us to understand how do we adjust the wrong debits and the wrong credits to our banker. We need to adjust wrong credits and then wrong debits. How do we adjust those? How do we adjust this in our bank reconciliation statement? Now, wrong debits means that the bank has debited your account in error, and the bank to debit your account in error, it means that they have reduced your account balance unnecessarily. And when you prepare your bank reconciliation, when we are preparing the bank reconciliation statement, we know that the two main items that we use over there are the unpresented checks and then uncredited checks, as we saw. But now we need to also ask ourselves the effects of wrong debits and wrong credits on the account balances of the business. And if the effect, so these two, we are supposed to ask ourselves, what is the effect or what is the impact of these two? That's the only thing you can know. Now, you just look at the impact. What is the impact of the wrong credit on the account balances of the business? And if the effect is the same as, so if the effect is the same as that of uncredited checks, for example, if let's say the effect between these two, or the impact is like it impacts the account balances of the business in the same way as that of the uncredited checks, for example, then we will treat that same transaction in the same way. And if the effect is the same as that of unpresented checks, then we will treat them in the same way. So we just look at the relationship. What will be the impact of that transaction on the account balances of the business? But you need also to understand that we said wrong debits means that we have reduced our account unnecessarily. In other words, we have reduced it in an unnecessary way. But when you look at the uncredited checks, they also behave in the same way, because you thought your account balance is going to increase or is going to go up, but it has not. It has been reduced. Therefore, it means that wrong debits usually move in the same direction as the uncredited checks. So these ones, the wrong debits will go in the same way as uncredited checks. So once you add back uncredited checks, even the wrong debits are supposed to be added back. If you less off uncredited checks, then wrong debits are also supposed to be deducted. So whichever format you go by, but you look at the relationship. Wrong debits, we reduced our account unnecessarily. Then uncredited checks, we thought that our accounts are going up, but unless it is reduced. So they are behaving in the same way. So the behavior of the two makes it to go in the same way. Now, for wrong credits, when we look at wrong credits, it means that the bank has given money into your account. The bank has put money into your account without your knowledge. In other words, they have given you someone's money to your account, and your account balance has increased, or it has gone up unnecessarily. However, if you look at the unpresented checks, you can see that it behaves in the same way, because we thought that the suppliers had presented their checks to the bank for payment. And for us, we had already reduced our bank account. We thought our bank account had already reduced. In our mind, we had already done that. But when we got the bank statement, we realized that our account never reduced. It actually meant it was higher than what we expected. Therefore, when they are not presented for payment, the balances at the bank will still be higher than that of the cash book. And that money is not going to be ours. It's not for us as a business. And the bank can still remove it from our account. Because when they give you someone's money, they can rectify the error and they deduct it from your account. So it is going to behave in the same way like the wrong credits. Wrong credits are going to behave in the same way like unpresented checks. Unpresented checks. So the same way we treat the unpresented checks is the same way we are going to treat these uncredited, the wrong credits. So that's what I want you to understand from this perspective. And I want you to get it that wrong credits move with unpresented checks. Wherever it moves is where the other one goes. And the wrong debits move with uncredited checks wherever it moves. And for the purposes of remembering, we can take it that wrong debits goes with the uncredited checks, and then the unpresented checks goes with the wrong credits. And basically what we will do is maybe to move over to the bank reconciliation statement. Then we indicate those, we get to the format of the bank reconciliation statement format, so that we can be able to adjust to including those wrong debits and then the wrong credits. So we can assume that we are taking one format of going with balance as per the adjusted cash book, then we add in those two items accordingly. So we have, this is balance as per the adjusted cash book. The amount is there. Then we add unpresented checks. The amount will be there. Then we also add wrong credits. The amount is there. Once you have added those, you can take off less uncredited checks. Then we also less off the wrong debits. And whatever we get is what we call the balance are as per the bank statement. Now you can see we have made just a slight change in the format where we are now introducing in the wrong debits and then the wrong credits. And we have seen that the wrong credits move with unpresented checks, and also wrong debits move with uncredited checks. However, I want to emphasize that here I did not say that we just add wrong credits and subtract wrong debits, but I said the wrong credits move with unpresented checks and the other one moves with uncredited checks. So you have to be very careful with that. Finally, I want to introduce to you how to correct errors in the financial statements that we may have. But I want to see how can we be able to incorporate these errors under our bank reconciliation statement. But what you need to know is that errors can be corrected anywhere. They can be this side up in the additions, or they can be down in the side of subtraction items, because it depends on the effect or the impact of the errors that you have. And that's why I can't say that this error can be corrected in such an area, or these are going to be corrected in this side. But what I can tell you, I can give you the general aspect or the general way of how errors can be corrected in the bank reconciliation statement. Now, correction of errors under the bank reconciliation requires a lot of technical understanding of these basic principles that we spoke about earlier, because we've talked about very many factors, and it's among those factors where we are going to be committing some errors. But you have to remember that, as I told you, that the wrong credits moves with unpresented checks because they have the same effect or they have the same impacts on the bank statements. And the wrong debits also moves with uncredited checks because they have the same impact or they have the same effect on the bank statement. And you have to note that I didn't say that those two, I didn't say that we add wrong credits and we subtract wrong debits. No, I said wrong credits move with presented unpresented checks, and wrong credits move with uncredited checks. And that is very important, and you need to note, because the implication is that wherever the unpresented checks are going to be, or wherever you find the unpresented checks, these items are going to be following them. Wherever you see the uncredited checks, the wrong debits are going to be following them, because we've seen different formats of how to handle, where we can start with the bank overdraft as per the adjusted cash book. We also looked at how we do it when we start with the balance as per the adjusted cash book, as per the bank statement. So we need to understand, but the key principle is in the effect. You look at the effect, what will be the effect of that transaction to the statement that we are talking about of the business. So if you see an error in the question, you should ask yourself, what is the effect? Or what is the impact of that error? The impact of the error. What is the impact? Because once you understand the impacts of the error on the bank statement, then you can be able to know where you can put it correctly. So if that error has the same effect or it has the same impact as the unpresented checks, and the wrong credits. So we gave two issues. We look at it in this way. We get the unpresented checks, we combine them with wrong, we combine that with wrong credits. We say those two move together. So once you see an error behaving or impacting the statement in the same way as these two, then it's supposed to be added. So if the same effect or the same impact as that of the unpresented checks and the wrong credits, then you should treat that error in the same section as well as those two items. So that error that is going to be on this side will come this side. And then the error that will be on the uncredited checks, that will have an effect which is the same as the uncredited checks, as well as the wrong debits. Then that error will also come this side. So we can have errors here and then errors here. Now, how do we know that this error is going to be on this side? We look at the effect. So if they behave in the same way, then they are supposed to be in the same way. So once an error is behaving like uncredited checks or wrong debits, then we should treat it in the same way together. So the whole idea of errors is to look at the nature of the error. For example, if you are told that the bank credited our account with 10 million, let's just get this scenario. The bank credited with our account with 10 million instead of 1 million. Because they were supposed to credit our account with 1 million, but instead they credited it in error, 10 million in error, but they credited it 10 million, then it will be an error. So we need to first understand the effect of this error, because instead of 1 million, they credited it with 10 million, meaning that they have overstated our bank account. They have overstated our bank account balances, whereby they have increased the balance of our account unnecessarily. Therefore, you have to ask yourself where this error can it be corrected, because you have to remember that I told you that if an error is committed in the bank, you should always correct it from the bank reconciliation statement. And it's true that this one has been committed by the bank because they have overstated our balances. Now, we look at now the unpresented check. Now, the unpresented checks and the uncredited checks, which one of the two will overstate our balances as well? And you can see that the unpresented checks, it will overstate the balances, and also the wrong credits will also overstate the account balances. Because for unpresented checks, we thought they had already withdrawn money, yet they haven't. But the balance on our account will be higher than we expected to have. And in the same way, when the bank commits an error, and then that error expects to overstate the balance, then we correct that error here with the unpresented checks and the wrong credits. So this error, we're supposed to receive this, but they gave us this. So the error that we are supposed to take here is that overstated figure. So they gave us 10 million on the credit. So what you do, you just come here and you take the difference. The difference, we take it back. The overstatement is the one that we are taking. So it will be 10 million minus 1 million. That will give you 9 million. So once you bring it this side and you add it back, you have removed it. You have left there only 1 million. But now it may happen that if for instance, if the bank commits an error and we analyze the error very well and we realize that the error has an effect of reducing the account balance, then that error will be corrected together with this thing. So the one that is going to underestimate, so we take the error that is going to underestimate, we'll take them together with these three items. I hope we are getting how we are able to maneuver through some of these items, because I told you errors will call your understanding of some of the things that we spoke about. Therefore, that's how we are going to treat the errors. And finally, I'm going to make a final draft where I want to include in the errors that will overstate and those that will understate in our complete format for bank reconciliation statement. So let's look at the complete format for bank reconciliation statement. As at, we put the date. Of course, as I said, we are taking the other format of starting with the balance as per adjusted cash book, balance as per adjusted cash book, that figure, then we add back. Of course, we add back unpresented checks. I said if there are many, you add them up. But let me assume it is just one value. Then we are supposed to add wrong credits. Then we also add errors that overstate. Errors that overstate the bank balance. the bank balances, we add it there. So we take the final value this side, and that will give us a certain balance that where we are going to less. Then let's go and see what we are going to less. So we are less the uncredited checks. The value will be there. Now we put it this side so that we add the others. If there are many, you first list them, you add. Then you also bring in the wrong, you less off also the wrong debits. Then you also show the errors that understate the bank account balances. So we take it that side, and then we shall have the final figure. That final figure will come as our balance as per bank statement. So that's basically what the complete format of bank reconciliation statement will look like, and I'm sure that you have now understood it very well. You can now be able to look at a practical question, but now we are going to take that practical simulation in the next video so that we can be able to understand. But if you have any question, you can put it in our comment section. We'll be waiting for those comments so that we can be able to respond before we dive into the computations, because we are now done with whatever we wanted to do. We want now to start looking at numbers. We are going to start from the very basic numbers as we keep on progressing, and we shall add just some of those different key items that will come across the different questions that we are going to be attempting. So thank you for watching. Let's be able to apply the principles and execute them practically in the next video. We'll see you there.